Bismillahirrahmanirrahim. This is the first video on elimination of unrealized profit on intercompany sales of inventory. In this video, first we will define the terms we need to know related to this topic. Next, we will talk about consolidated financial statement in case of 100% and less than 100% downstream sales in the first year. Finally, we will talk about year 2 eliminating entries in case of downstream sales. But in the beginning of this session, I would like to thank my son, Muhammad Abdullah Khan, who gifted me an iPad along with all the necessary accessories without which making these videos would not have been possible. I would like to thank Nabia Khan for helping me out in preparing these awesome slides. I would like to thank my wife, Samina, for her care, encouragement, and constant support, who allowed me to use time for her in making this video. Let us look into some terms that are relevant to this topic. The first term is consolidated entity. A consolidated entity includes the parent company and all its subsidiaries. We prepare consolidated financial statements for such an entity and all the subsidiaries report under the umbrella of a parent company. This term is important to know as accounting recognizes only the profit outside the entity. Next is the upstream and downstream sales. These terms are associated with intercompany sales. Upstream is a subsidiary selling to the parent company, while downstream sales are from parent to subsidiary. Parent selling goods and services to the subsidiary. In this video, we will focus on downstream sales. Next is the horizontal sales, that is subsidiary to subsidiary when a subsidiary sells to another subsidiary. Next we have affiliated group. An affiliated group is two or more companies that are related through common ownership but are treated as one for federal income tax purposes. An affiliated group consists of a parent company and one or more subsidiary companies. Next we have unrealized profit and profit that is not realized through subsequent sales to the third party is defined as unrealized intercompany profit. Such profit must be eliminated in the preparation of the consolidated financial statement. Any profit or loss generated by intercompany sales between the parent and subsidiary or between one subsidiary and another subsidiary must be eliminated. While preparing the consolidated financial statements, the intercompany sales must be eliminated from the total sales of the consolidated entity. Only the sales to third party outside the affiliated group will be recorded in the consolidated financial statements. The consolidated sales will include only the cost of sales to the affiliated group of the goods that have been sold to parties outside the affiliated group. In other words, the cost of goods sold is the cost of goods sold for the original purchaser of the affiliated group. Suppose the subsidiary purchased assets for 5,000 and sold to the parent company for 7,000. Later on, the parent company sold to the third party for 9,500. So the cost of goods sold for subsidiary is 5,000. The cost of goods sold for parent company is 7,000 because the parent company purchased from the subsidiary for 7,000, but the profit to the affiliated group will be 9,500 minus 5,000, that is 4,500, and not 9,500 minus 7,000 because the cost to the affiliated group is 5,000 and not 7,000. The consolidated inventory on the balance sheet is recorded at its cost to the affiliated group, as in accounting we look at the affiliated group. Thus, the objective is to eliminate the effect of intercompany sales as if they never have occurred. Let us look into a basic work paper eliminating entries that are required because of intercompany sales of merchandise. P company sells all goods it buys or manufactures to its wholly owned subsidiary S company at 125% of cost. During the first year of this arrangement, goods that cost P company 200,000 are sold to S company for 250,000. During the same year, S company sold all the goods purchased by it from P company to third parties for 270,000. So P company sells to S company for 250,000, that cost them 200,000. So the gross profit of P company is 50,000. S company sells to the third party for 270,000 and the cost for S company is 250,000. So the gross profit of S company is 20,000. Let us first pull the numbers in P company and S company income statement and the balance sheet. The sales of P company is 250,000. The beginning inventory is 0. Purchases are for 200,000. So the cost of goods available for sales is 200,000. The ending inventory is 0. So the cost of sales is 200,000 and the gross profit is 50,000. Regarding S company, the sales is 270,000. The beginning inventory is 0. The purchases are 250,000. So the cost of goods available for sales is 250,000. Ending inventory is 0. So the cost of sales is 250,000 and the gross profit is 20,000. Now the sales of P company to S company is an intercompany sales, so it has to be eliminated by debiting the sales. So the first elimination is of sales by 250,000 because P company sells to the subsidiary. Similarly, purchases by the subsidiary from P company must be eliminated because such a transaction has taken place because of intercompany purchases of 250,000. No unrealized intercompany profit exists since all goods sold by P company to S company have been resold to third parties. After the elimination of intercompany sales, consolidated sales of 270,000 equals the amount of sales by the affiliated group as company to third parties and consolidated purchases of 200,000 equals the cost to the affiliated group P company of purchasing the goods sold. The work paper entry in the year of the sale to eliminate intercompany sales is debit by 250,000 and purchases are credit by 250,000. Failure to eliminate intercompany sales would result in an overstatement of sales and of purchases in the consolidated financial statements. If the intercompany sales were not eliminated, the gross profit would be sales for P company is 250,000. The sales for S company is 270. So that makes 520,000. Then the cost of sales for P company is 200,000. For S company it is 250,000. And the consolidated balance for cost of sales will be 450,000. The gross profit for P company will be 50,000. For S company it will be 20,000 and the consolidated gross profit will be 70,000. The gross profit when we go for the elimination is also for 70,000. So if the intercompany sales were not eliminated, the consolidated gross profit would be correct in both cases, but the gross profit percentage would not. The gross profit percentage here will be 25.9%, while failure to eliminate the intercompany sales would show a gross profit of 13.5%. Sales will be the same 100%, but purchases over here are going to be for 74.07%, and here the cost of sales will be 86.54%. Now, since both sales and purchases would be overstated by the same amounts, consolidated net income is not affected by the failure to eliminate intercompany purchases. However, a number of financial ratios based on sales revenues would be distorted if the eliminations were not made. The calculations that I have explained over here, I have put it in an Excel sheet as well, and they are displayed here. In case if there are any mistakes in my calculations, please let me know in the comment box or by email, and inshallah I will reply you back. Now, assume that S company sells 60% of the goods purchased from P company to third parties prior to the end of the current year. So let us see how the income statement and the balance sheet of P company will look like. We will take the data from the previous slides. The sales of P company was 250,000. The beginning inventory was 0. Purchases were 200,000. So the cost of goods available for sales is 200,000. Ending inventory is 0. So the cost of sales will be 200,000 and the gross profit will be 50,000. Now, since the parent company has sold 100% of its inventory, the ending inventory in the balance sheet for P company will also be 0. Recall that S company sold 100% to third parties in the previous slides for 270,000. The income statement and the balance sheet of S company will look like now. We have 60% sales, so 60% of 270 is 162,000. The beginning inventory is 0. Purchases were 250,000. So the cost of goods available for sales is 250,000. Now we are selling 60%, the subsidiary is selling 60%. That means 40% of 250,000 is still there in the ending inventory, that will be 100,000. Now, and the cost of sales will be 150,000 and the gross profit will be 12,000. Now the first elimination will be for sales of 250,000. This will give us a consolidated balance of sales as 162,000. There will be elimination of purchases, so for 250,000, and now we have the balance of 200,000. So we have sales, we have beginning inventory 0, we have the purchases, consolidated balances for purchases, and now the cost of goods available for sales is 200,000. Now the parent company sold 100%, so they have the ending inventory balance as 0. But as company sold 60% to the third party, so there is ending inventory of 100,000, and this includes intercompany profit, and that will be 40% of 50,000, and this has to be eliminated. Now this profit has not yet been realized by the consolidated entity through sales to outsiders or third parties, so this has to be eliminated. And this profit is also so when we eliminate, we are going to debit the ending inventory by 40% of 50,000, that is 20,000. And this profit is also included in the inventory balance in the consolidated balance sheet and must be eliminated here as well for 20,000. The ending inventory for the subsidiary is 100,000 and the balance inventory or the consolidated balance for inventory is 80,000. And here also the ending inventory is 80,000. So the cost of sales is 120,000 and the gross profit is 42,000. The elimination entries will be sales debit by 250,000 and purchases debit by 250,000. Then there is elimination of unrealized profit in the ending inventory, and for that ending inventory income statement is debit and ending inventory balance sheet is credit by 20,000. Now these two entries for intercompany sales and unrealized profit in ending inventory will be the same regardless of whether the parent company uses the cost method or partial equity method or complete equity method. However, we will see now that the entries for intercompany profit in the beginning inventory differ slightly for the second year. In the next slide, I have put the calculations on an Excel sheet, and you can compare my explanation with this sheet. And again, I request my subscribers and my viewers, if you find any error or mistake in my explanation, please let me know in the comment box or by email, and inshallah I will reply you back. Now assume that in the next period P company sells merchandise to S company in the amount of 500,000. Cost is 400,000. And that S company sells all its beginning inventory, 100,000 cost to S company, 80,000 to the consolidated entity, and one half of its current purchases from P company, 250,000 cost to S, 200 cost to consolidated entity. They have sold to the third parties for 378,000. So this is for the year number 1, and this is what we have done in the previous slides. And now we are going to prepare the income statement for year number 2, that is the next period, as they say. So the sales is 500,000. The beginning inventory is 0. Purchases was 400,000. So the cost of goods available for sales is 400,000. The ending inventory is 0. So the cost of sales is 400,000 and the gross profit is 100,000. The income statement, okay, let us continue with the balance sheet as well. Now, since the parent company has sold 100% of its inventory, the ending inventory in the balance sheet for the parent company is 0. Now, the income statement and the balance sheet of S company will include sales of 378,000, beginning inventory will be 100,000, because if you can remember, the ending inventory of year number 1 is 100,000. So the beginning, this becomes the beginning inventory for S company, 100,000. The purchases were for 500,000. So the cost of goods available for sales is 600,000. The ending inventory is 50% of 500,000. So that makes 250,000. So the ending cost of sales is 350,000. And the gross profit will be 28,000. Now, since S company is selling only 50%, the ending inventory will be 50% of 500,000, and that is 250,000. And this is recorded over here. Okay. Now, note that the account ending inventory income statement has a normal credit balance because it is subtracted in computing cost of sales. That's why ending inventory income statement requires an entry distinct from that to the balance sheet account inventory. Let us now look into the work paper entries, or first of all we look into the elimination entries for the second year and see how they are similar or different from the first year. As already stated, the two work paper entries on intercompany sales and unrealized profit in ending inventory will be the same regardless of whether the parent company uses the cost method, partial equity method, or complete equity method. First, we are going to apply the cost method or partial equity method to record these transactions. Now, the first elimination is for the intercompany sales, and intercompany sales is 500,000 and the consolidated balance will be 378,000. So the consolidated balance for sales is 370,000. At the same time, the purchases has to be credited for the intercompany purchase, and that is of 500,000. So the purchase now for the consolidated purchases are 400,000. We will talk about beginning inventory in a while. But first of all, let us look into the elimination entry for unrealized profit in ending inventory. We have an ending inventory of 250,000. Now, since S company sells only 50% of its current purchases to third parties, so there is ending inventory of 250,000, and it includes intercompany profit, and that will be now ending is 250,000 minus cost to the parent company divided by the sales value of the parent company times 250,000. So that is 250,000 minus so that is 200,000. So that makes 50,000. So the ending inventory income statement will be debited to reduce by 50,000, and this is transaction number 2. 50,000 has been debited to eliminate the profit that is there in the ending inventory. Now, this profit has not yet been realized by the consolidated entity through sales to outsiders or third parties, so that's why it has to be eliminated. Now, this profit is also included in the inventory balance sheet in the consolidated balances and must be eliminated here as well by crediting it for 50,000. So the consolidated balance for the inventory now is 200,000. We will talk about the journal entry in a while, but now let us talk about something that is new in the second year, and that is the elimination of profit from the beginning inventory. Now, in the first year, the ending inventory in the balance sheet of S company is 100,000. That's why S company has recorded this in the recorded the beginning inventory for the second year as 100,000. However, This beginning inventory includes the profit because intercompany sales, that is 40% of 50,000, 20,000 must be eliminated. So 20,000 needs to be eliminated. So 20,000 will be credited. So we are going to credit the beginning inventory income statement by 20,000, and now we have the beginning inventory. We have 20,000 and this was 378,000. This was 400,000, the purchases. So the beginning inventory now is 80,000. So the cost of goods available for sales is 480,000. At the same time, we are going to debit the beginning retained earning for P company. Okay, we are going to debit the beginning retained earning for P company, and when we debit it, this is number 3, and that is going to be 20,000, and I will explain you this in a minute. Now what you can observe that the adjustment to beginning inventory in the second year is of the same amount as that to the ending inventory of first year. You can see that for S company we have the beginning inventory of 100,000 and we have eliminated 20,000. And this is going to be 500,000. So we have eliminated 20,000 to beginning retained earning of P company for cost or partial equity method. Now in the previous year, P company recorded 50% in profit on intercompany sales. At the beginning of the year, 40% of that amount has not been realized by sales to third parties. That's why it must be eliminated from the beginning retained earning of P company to correctly reflect the beginning consolidated retained earning. Yet another way to look at the debit to beginning retained earning may be in determining consolidated net income in the first year, 20,000 was deducted. From the reported income statement and thus from the retained earning of the affiliated group by a work paper entry. Now, in order for beginning retained earning to match the prior year's ending retained earning to the consolidated entity, this 20,000 adjustment must be made to beginning retained earning so that we can have the balance as in the first year. Let me complete now the statement. So ending inventory now is 200,000 and the cost of sales will be 280,000 and the gross profit will be 98,000. Let us now prepare the work paper entries and let us see how they are going to be recorded. Now again, the calculations that I have done for the second year are recorded in I have prepared in an Excel sheet, and you can verify from this part But in case if I have made any mistake in my calculations, please share it in the comment box or by an email. Now once we have done that, next is we are going to prepare the journal entries, and the first one was for the elimination of the sales. 50,000 sales is debit and purchases is credit by 500,000. Then the second one will be for the elimination of the ending inventory profit, intercompany profit, ending inventory income statement, ending inventory income statement, and that is 50,000. And ending in ending inventory balance sheet is credited by 50,000. So these, if you look into the first year elimination entries, we have the same here as well. So these are the similar entries. The difference is for the number 3, and in number 3 we have to eliminate the intercompany profit that is there in the beginning inventory, as well as we are going to bring in the beginning retained earning P company for the debit. So beginning retained earning P company is debit by 20,000, and beginning inventory income statement is credit by 20,000. Okay, so that's how we complete our explanation. And again, I have put the Excel sheet for this calculation. You can verify it, and if there is any mistake, please share it in the comment box. Next, we are going to look into how we are going to record these transactions for the complete equity method for the second year. For the first year, for the second year, for cost or partial equity method, we have already completed. But when you look into the complete equity method, there is no change as far as the consolidated balances are concerned or the adjustments are concerned. The only difference is in the with reference to the beginning retained earning that we have debited in the case of a cost method or complete equity method, and this has been substituted by investment in subsidiary, and let us look into it what we mean by that. But having said that, you can see that the intercompany sales and unrealized profit in ending inventory entries are the same. So the firm using the complete equity method the debit to beginning retained earning is not needed. We have not put the beginning retained earning as it was for the cost method or complete equity method. Under the complete equity method, consolidated retained earnings is identical to the parent's reported retained earnings, and thus no adjustment is needed. The debit to retained earning is replaced by a debit to investment in subsidiary. Now remember, this was in the retained earning, but since we are using the complete equity method, we have recorded this in the balance sheet as investment in subsidiary, and let us see why we do that. The debit to the retained earning is replaced by a debit to investment in subsidiary, and this serves simply to facilitate the elimination of the account on the work paper. Now, investment in subsidiary is 20,000 and the beginning inventory income statement is credited by 20,000. And this is done to realize the gross profit in beginning inventory deferred in the prior period. Now you can see that the consolidated sales are 378 are equal to the amount of sales of the affiliated group to the third parties. Consolidated cost of sales is 280,000 and this equals the cost to the affiliated group of the goods sold, and this is calculated as cost of goods transferred to S company, 40% of 200,000, that is 80,000. Cost of goods transferred to S company in current year and sold this year, that is 50% of 400,000, that is 200,000. The cost of sales to the third party during the current year is 280,000. The consolidated inventory of 200,000 equals to the cost to the affiliated group P company of the goods on hand at the end of the year, that is 50% of 400,000, that is 200,000. So this completes the first part of our explanation on elimination of unrealized profit on intercompany sales of inventory. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Happy learning.